Well, hello everyone. Don Garman here again, another month. Mirador Capital Partners. Here we are, middle of February. I skipped last week quite intentionally. We had a nice, smooth upward slope going, and I felt a bit like a no hitter that I didn't want to come on. I was going to wait for a down day, and sure enough, here we go. We have one today. So, one of the things I will thank you for is I can tell because I get texts now from a certain group of you who apparently appreciate frequent monthly check-ins on the status of our positioning relative to the market. And I got a few texts over the last few days saying, hey, you haven't done a video for a while, so get back to it. So here we are. We will get back to it. I'm going to update some of the thoughts I had. And in a lot of ways, I'm going to tell a bit of a different story than the narrative shift that we talked about at the end of October. So obviously, looking back to that video where the fundamental message was the downward slope in earnings that we had observed for over a year, 18 months, had stopped. And I'm going to share my screen for a second, and then I will come back to you here. So what we have been guided by in our process for a long time is about the direction of this line. And this is a historical view of earnings estimates. And in this instance, somewhere in this mid-2022 period, the line started sloping significantly downward. This coincided with the inflation narrative, and companies were going to be estimated to make less money in the future, as judged by this analyst community, earnings estimates, we call those. And the line was pretty significantly downward sloping. And coincident with that, our positioning was very defensive. We had lower equity exposure, higher hedge, and were more or less braced for rocky movement in the markets at the index level. And certainly 2022, we all know now looking back, as we've all heard, the worst year for stocks and bonds in the same year in 100 years, and had to get through that rate hiking cycle. And for several months now, people have been front running the idea that, in fact, the Fed will start cutting rates. And that makes things like small cap and things that need to raise money or refinance, puts them in a better position. So today, the CPI reading suggested that that narrative might not be as near term as many had hoped. But what I'm going to focus us on today is this column here, which we're going to call PEX. So it relates to this column, the earnings per share of, think of it, the 500 best companies in the world through time, and what we are going to pay for those earnings of those companies at the index level. And I know we don't buy the index, but the point is the same. If you look back here to September 22, September 30th of 2022, you'll see it was 15 times $238 estimate. And since then, we are now at 23 times, which is obviously a lot higher than 15, and 218 is the current estimate. What point am I making here? Well, a couple points. From July 31st of 2023, when the estimate was 216.92, obviously directionally 218 is going up, not down, but it's not going up a lot. What has gone up a lot is this PE ratio has gone up a lot. So what does that mean? So what it means is we are not in as good of good of a position from a forward-looking standpoint as we were back in October when we shifted from more defensive to more aggressive, which is what we did then. In many ways, we are at the opposite side of that risk reward continuum. So you may have noticed we're starting to bring the defense back on the field. And what we would love to see is the earnings estimates starting to rise more rapidly. Looking back now a couple of years ago, people were expecting the S&P 500 to earn 248, you can see back here. $248 in total earnings. And the current estimate for that same batch of companies is 218. Equate this to your own income. If you were expecting to make 248 in 2022 and you're making 218 in 2024, you're not feeling quite as optimistic, and I guess it would be one way of saying it. So the point being, we've come a long way. We all know markets don't go up or down in a straight line. We had to endure a long period of readjustment and pricing of a lot of assets, which is a lot of it's happened. We know we get a lot more yield from the bond portion of our portfolio and more stability than we do from the equities than we have in a long time. So it makes those more attractive. So my simple story here is it's not a cataclysmic outlook. It's just not as rosy as it was. And therefore, we would play the hand differently. We would play it fundamentally more conservatively and less aggressively, somewhat of the mirror image of the end of October. So I'm happy that there is a slight upward slope to this line over here. That's great. We will know that there is a more fundamental and more enduring fundamental move when this 218 starts going to 224 and 228 and 236, and that would be an indication, obviously having to do with a complicated relationship between margin and sales, but it would indicate growth and companies' ability to capture that growth in earnings. But that's not the condition that we're observing right this minute. We've just had a lot more valuation for, in essence, the same dollar of earnings. Not in essence what we want to see. But I'll stop there for now. Thank you to those of you who have taken us up, particularly Jackson, on the financial planning piece, which is much improved, I would argue, better than it's ever been from a firm-wide level. Some of you have now been through the estate planning piece, which is great. If you have interest in that, please let us know. I keep threatening to do it and haven't done it yet, which is I'd like to do a Zoom where we introduce some people at the firm by face, because many of you haven't been in a long time, many of you way before COVID. And so it'd be good for you to at least see the people who you get to connect with on the telephone, at least have a feel for what they look like, although you can see it on the website. So we'll leave it there. As always, thank you for everything. If there's anything we can do, any of us, please let us know. And we will keep trying to navigate this year, which is now well underway. And I will be back in touch at some point in March, although the first part of the March month I will be away, but I may even try to do something from where I am and get something out. So anyway, I'll leave it there. Thanks, everyone. We'll talk to you soon.